Hello, everybody, and this is the May update for Quadriga stable return strategy. Before updating on the month of May, the returns and in terms of for a fund and for a bucket, we're gonna go through quickly the presentation and the strategy. So you already know that for us, we consider a portfolio in the portfolio management as a managed team. It could be a football team where the investor or let's say the allocator, as in this case is us as Quadriga, we are the coach, and you need to define a strategic neutral asset allocation, pick internal and external players for the final role in this allocation, and then the most important thing is to actively rebalance the team. So for us, the long-term success is not just about the offense, so pure compounding capital, but also capital preservation in turbulence time. If you look at the situation today, we see that we have let's say few challenges ahead of us, especially more smaller clients. They have few challenges. First of all, the cash and money market is they deliver negative returns, and if you go into more long-term fixed income, you still have potentially nominal negative returns, and sometimes especially negative real returns, and the risk rewards of the yields of the bonds, of the government bonds, is not very attractive. You go to duration 10, 20, 30 years with volatility, they can be up to 10%, 12%, and there is very small margin of safety. The potential capital losses can be higher than the capital appreciation, which the only way to get more capital appreciation in the future is lower yields from now. Then if you go into credit in a high yield, we still see some pockets of attractiveness within high yield. Investment grade, we are very skeptic. The spreads are very low. So at the end, investment grade is a kind of replacement for long-term fixed income. Also, duration of investment grade is pretty long. So what we see there is you get the same risk in terms of rates risk, interest rates risk of government bonds, investing in investment grade, and the spreads is so tiny, so small that it cannot be a good cushion for you, protection from movements in interest rates. And then we go to equity. Of course, we still find a situation where the risk reward is still attractive. The real returns, also for some companies, they pay good dividend yields that are very attractive again. But then on the other side, we see some pockets of the market where the valuation are pretty extreme. So how do we handle these issues in this world where the interest rates are zero and the markets are all-time high? We built a new type of allocation, which is not anymore the classic asset allocation where you invest, let's say, between 40 and 60% in fixed income, because it is fixed income and it is meant to be preservation of capital and yield, and the rest in equity. Now, if you invest this 40, 60% in fixed income, you get very low income, almost zero sometimes. And I'm not so sure about also the preservation of capital during spikes in volatility. Let's just think of the Bund, 10 years Bund, that in March 2020 did just 3%, where the DAX was down 40%. Pick to throw. So what we're doing differently, we are moving from the classic asset allocation to behavioral allocation. So we divided our fund into three main buckets. One is what we call anti-bubble. We define like the goalkeeper or the defender of the team or the fund. And then the other bucket is the striker, so the equity risk on strategies, and the rest is going to be all the midfielder, so all the uncorrelated pure alpha generation strategies. So we put strategies or assets in each bucket according to their behavior. So we analyze their behavior in the long term, short term, and medium term. We analyze the correlation and their movements in a stress test scenario, and then we assess if a single strategy, according to the market regime we are now, it is more defensive factor, so goes into goalkeeper and defender bucket, or it is a striker factor. If we find a strategy that doesn't correlate much, it doesn't have sensitivity to either defensive factors or offensive factors, then the bucket for this type of strategy is the midfielder, the uncorrelated alpha generation. For example, this is a spider chart where we see the sensitivity of a striker of an offensive risk-on strategy. The middle, the center of the spider chart is 0 and the extreme is 10. So we see clearly that this strategy is an equity strategy. It has high sensitivity to beta factors. A mirror strategy is a defensive strategy, which is 0 on everything but the defensive factors. And then, of course, we have the alpha, which doesn't have sensitivity to the two extreme or left and right, but it has just correlation to factor alpha factor. And if we put all together, we get what we call stable return, and essentially is something that has all the factors but without any extreme. So there is this stable return has all the factors but a bit of everything, and the result is what we see in this table. It's just a pro forma. So we built a backtesting where having all these factors in different regime help you build this smooth profile that can preserve your capital during spikes and volatility, and try to achieve positive returns during periods of market booms and positive, let's say, equity markets. So I think you already know the team. It's me as a senior portfolio manager managing the strategy with Alfonso Torres and Diego Parrilla, which are in the investment committee, and David Serrero on the quantitative side. We go, again, this is the idea of anti-bubble, which I think you already know. For us, is a cheap, anti-bubble needs to be like artificially cheap valuation and effective edge, let's say like an antivirus, anti-missile. So VIX, it can be the classic anti-bubble where something happens, VIX spikes, and there needs to be some risk premium. So of course, many times, and most of the time, you need to be some contrary. You need to have some contrarian view to be invested in anti-bubble, like for example 2021, which has been a very tough year for anti-bubble, for being long volatility and long defensive assets. And this is a clear example how an anti-bubble works, where everything goes down or doesn't move much and the equity goes down a lot. You have this anti-bubble essentially mirroring the performance of equity on the other side, on the positive side. And here is the way we build the portfolio. So we have these three objectives. The first of all is capital preservation. The second is a stable income. We try to achieve the stable income through either the alpha, which are pure alpha, and they try to achieve small returns every year, which for us it's a kind of an income, and then an edge to potentially inflationary risk. Inflation is something that either if we don't have 5 to 6% inflation every year for the next 10 years, also 2 to 3% stable inflation is gonna erode your capital, especially if you're invested in fixed income. that has a yield lower than 2%. And there are plenty of fixed income instruments with yields between 0 and 2. Because investment grade, the yield to maturity now for a bonds at 8 years can be lower than 2% easily. So we don't aim to protect you on, let's say, a spike of 10% of inflation like in the 1970s. We don't have this view, but also a very stable and, let's say, small inflation, small print number like 2 or 2.5%, but for the next 10 years can really erode your real the value of your capital, real value of your capital for the next 10 years, especially if you leave everything in investment grade and government bonds. And there are 3 building blocks. The first one is what we call entry-free assets. This new, it's name invented by Ray Dalio of Bridgewater. Essentially, it's the monetary policy-free framework where we are going to have both an accommodative central banks, in this case the Fed or ECB in Europe, Bank of Japan in Japan, and also very expansive fiscal policy from the developed world governments. And this combination we think is gonna add a lot of value to certain assets, mainly in the equity space and some distress space. So this bucket is gonna be between 25% and 50%. Then we have the anti-bubble, which is gonna, if you see the green dots, it behaves, this bucket behaves like a put option, make good money, good returns when the equity is down, and lose something, but not as the equity when the equity is up. And then we have our midfield, let's say, our uncorrelated strategies, which are more focused, the distribution returns are more in the middle, more normally distributed, and they try to achieve a small return every year. Is for us is a pick up an income for the fund, for the strategy. And the combination of these 3, and we get what is stable return. So after this, I will go to the monthly update. But yes, here we are. First of all, we have also an update on stable return versus the peer group. In this case, we show one of our main competitor, which is Nordea Stable Return. It's very good fund, and it's a big fund. It's been around for many years. So what we did in this chart, essentially, we ranked the returns of stable return from the worst to the best return since January, starting from January 20, when we started also Quadriga Stable Return. And then we assess what happened during those Nordea Stable Return negative or positive months, what happened to Quadriga Stable Return returns. And these are the blue bars. So if you look into the worst, let's say the worst month for Nordea Stable Return, we have essentially an average almost minus 9% for Nordea Stable Return, while for Quadriga it's just for Quadriga Stable Return is just minus 1.5. Then if you go into the, let's say, neither very negative, neither very positive month, so let's say more neutral month, we have Nordea Stable Return doing 1%, whilst Quadriga Stable Return doing better, 3.4%. So the quiet months where equity neither goes very up or very down, also there we get some more alpha against Nordea. And then on the where we don't make money as Nordea makes is on very positive months. So when there are very positive months. Nordea makes around 13% on the upside, and Quadriga has a return 8% on average. So what does it mean? Usually these months are also the months where markets are very up, very positive. So what we want to show here is it's not that Nordea is not a bad fund, but it's more it relies more on the equity markets, whilst Quadriga relies more on markets that are more, let's say, alpha markets, where you don't have like a huge rally, but let's say more stable market where we can explore our accurate strategy and our alpha. And on months where volatility spikes, markets are down, we have 20%, moreover, more or less 20% invested in long volatility strategy. So we are also long volatility. So we are long volatility, long alpha, and less beta than Nordea. So I think it's a good diversification for a portfolio that has just Nordea or maybe MAN or MFS as a multi-asset fund or multi-strategy fund. We add some value here because we are less, we rely less on beta and more on alpha and volatility. So if you look at the May update, the month of May was good. We were up 2%, whilst the investment grade was flat, 0.1. And then year to date, we are now 0.4 positive, so finally a positive update, and the volatility of 5%. The chart below shows our let's say performance against our target, European inflation plus 5%. We were still, although after August 2020, September has been kind of hard for our strategy due to the low volatility also profile of our strategy. It's been kind of hard to produce positive, consistent returns. We still kept our target after 1 year and a half, our target of inflation plus 5%. And here is another way to see the performance, but it's just a zoom on the year-to-date performance. Against the red line is the Vanguard European Investment Corporate Grade, and if you see, it's more or less the strategy is moving around the same profile of investment grade, but slowly with better performance now. And so we want to say essentially is we are not adding too much risk in terms of volatility and day-to-day P&L to an investment in fixed income or an investment grade bond, but I think we have a better and clearer upside, potential upside than investment European investment grade, where the yields are so low, the government bond yields are so low, and also the spreads are so low that essentially the corporate credits they are issuing debts are very, very low on yields. And this is the chart where we show since inception the three components. So there are two things here: both anti-bubble and equity made money. So after 1 year and a half, both component, the risk on and risk off, made money. Of course, with correlation -1, but both of them made money. And now it's a very interesting time to see what's going on, because essentially equity made a lot of money and recovered well after the 2020 March crisis. And while anti-bubble, who started to essentially started very well after February March 2020, lost a good part of that of those gains, but still managed to keep after 1 year and a half positive returns. So now we are in a situation where it's going to be interesting. Either we're going to have lower volatility, higher markets, and we're going to make money there. And hopefully the anti-bubble are going to preserve the gains they made until now, or we can also have a spike in volatility where we're going to lose portion of equity assets, but we're going to see anti-bubble shining again. And on the uncorrelated side, it looks like it's been, let's say, very stable and not very didn't add much value. Essentially, what we did the last year and a half, we just look into new strategies to add, and now the last month and a half, we started to have more. We started to add more weights to this bucket, to this strategy. So I think we are going to see the results during the second half of 2021. And the next slide is on this interesting chart on factor. Sorry, table. This number this table has been taken from Python. It's one of our tool we use to assess risk. And I was talking about looking at the spider chart, stable return having all type of factors. So what we for us to understand in a quick way our risk, linear risk of the strategy, we use let's say top macro factors that can be gold, dollar, rates, VIX, equity markets, growth and value, energy markets, and also yen. And if you look at all these factors with the for each bucket, but also the portfolio level, you see that at portfolio level we essentially have all these factors. And if we divide it, we do a breakdown of the factors which are more risk off, factors that are risk on, and factors that are correlated. If you see the risk contribution today, the delta, today we have for risk of assets, risk on factors, and uncorrelated factors, you see that we have 20% deltas in the risk of factor. It can be gold and treasuries and VIX. We have 40% of risk on, can be equity markets. In this case, rely more on cyclical and industrial and emerging markets rather than growth factor portfolio level. And the uncorrelated factors is the one there where we have more delta. It's almost 50%. And here is the composition of the portfolio. We have now 46%, almost 47% in equity, where we have US stocks and European stocks, the main component. Also infrastructure in US is also the big component, is 6%, and is doing pretty well. And on the anti-bubble side, we kept the two strategy we have currently. So one strategy is golden, relies more on golden volatility, and the other one is volatility arbitrage. And the uncorrelated bucket is 42% at the end of May. We added another strategy during June, but let's say now we have more weights in uncorrelated. And we introduced also Asia FX, Chinese yuan, Indonesian rupee, and Indian rupee as a trade to get exposure to Asian, let's say Asian currencies versus the euro. And then let's say the rest is we added also long short equity, as I mentioned last month. It's an internal strategy that Christian Thum and Jose Maria Aznar, they manage both together. It's a long short strategy with, let's say, a structural long bias of 60%, and it's doing well. During the month of May was up 3%, so it really contributed positively to the portfolio. And so this is, I think, the composition of the portfolio. And just to finish, these are the free share classes. The silver share class still open, but for very high minimum investments. But the clean share class 75 basis point is up and running. Since the inception, this share class it's up 1.5%, and clients already invested pretty happy. So hopefully we just launched also the C share class, the one with rebate. So if you're interested in one of the share classes, you want to talk through the strategy, you want to have a further question, please don't hesitate to contact me or our client analyst Gabriele Scudero, and we can arrange a call. So thank you for your time, and we're going to talk by next month, the June update. Bye.